Okay, good evening. I can see a lot of people already joining in, so we're going to go ahead and get started. Thank you for joining us this evening for the New Capital webinar Special Markets Update. This is Catherine Barr, Director of Communications at New Capital. If you have any questions during the presentation, please enter them using the Q&A tool in the webinar menu. Leonard will answer any questions you have at the end of the presentation. And before we get started, I'm going to make the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources.
Okay, it's usually instructive to think about what you've done in past market drops when thinking about a current market drop. And so 85% of the people in the Black Friday market drop did nothing. They sat tight. To remind you, the Black Friday market drop in October of 1987 was a 22% drop in the market in one day. That's what was notable about that market drop. The market lost about a little between a fifth and a quarter of its value in a single day. And you may remember that it had to do with computerized trading, and there were some regulations that were brought to play after that to try to reduce computerized trading. Number two, what did you do in the 2000 tech bust? Again, 62% of the people did nothing, and 23% they sold a lot in the tech bust, and 8% sold a little. Going on to the 2008 to 2009 financial crisis, again, by far the most common response to that drop was 69% did nothing. Slightly higher sold a lot in the 2008 to 2009 financial crisis. Actually, same as what happened in the tech bust. But in general, what we see is that with a sample size tonight, let's say we've got about 20 people on the call, that by and large, approximately 2/3, a little bit more than 2/3 of our survey of investors and clients have generally, in these large market drops, not taken any sort of action either to buy or to sell. There are some buyings here. Nobody bought a lot in any of these. Some people bought a little. Some people sold a little. Some people sold a lot, 23, 15%. So in each of these, it looks like we get anywhere from 15% on up to 20% of people who really pulled the trigger hard. What do people want to do right now? Nobody wants to sell a little or sell a lot. A lot of people want to sit tight, and there's interest in buying right now. 23% are interested in buying a little, and 8% are interested in buying a lot. And I think there are reasons for that response, and I'm going to talk about that in the presentation tonight, because it's a story of alternatives right now. What are your alternatives? It's always a question of alternatives. So we're going to talk about what those alternatives are tonight. All right, I'm going to close this and get started. Obviously, the talk begins tonight with the virus. And I want to say, first of all, that everybody's health comes first. That's obvious. We had our sons. We celebrated our son's bar mitzvah this weekend. It was a wonderful event, and we want to thank all of our family and close friends who came in from out of town, and can tell you that we had a number of cancellations, including from some people here in town. One good friend and couple comes to mind. The husband had been to Japan recently. I mean, just the other day got back, and they were very, very concerned about coming as a result. No signs of any illness, but just didn't want to take any chances. And so we all are being affected by this right now in our travel plans or in our events, and so I hope that everybody will remain untouched by this virus that we know, and everybody on the line. The odds may be slim of that happening. My understanding is that eventually it's highly likely that a lot of people are going to get it, but it's also highly likely that it's not going to have any kind of mortal impact on the vast majority of people, which is the first bullet point here. The big question everybody's asking is, what's the actual mortality rate of this virus? And let me just say that I don't want to get myself in trouble in any way. There are physicians on the call, and so if I say something that's not right, shoot off a little comment and correct me, and I'll get to that at some point in the call. But estimates have been 2%, 3%, which is a lot of people if you assume a global outbreak of this virus. There are also estimates that it's lower than that, based upon the idea that more people have it than are reporting it, because so many people are asymptomatic, have just a little bit of a cough, and aren't sure that they have it. So the mortality rates could be much lower. Nevertheless, it appears to be, and I know everybody on the call knows all this, but it just bears repeating and bear laying this foundation underneath this call, that it is impacting older people and people who have pre-existing health conditions, compromised health already. These seem to be the people who are being affected. Children, adolescents do not seem to be affected at all. I don't think that's the case for very small infants who have no immune systems as of yet. And then others, I assume their experience is somewhere in between these youngins and the elderly and sick, maybe coming down with a good case of the flu. So the point here is that it does not look like we are facing the end times, as it were. That doesn't mean it's good, but it doesn't look like we have the bubonic plague with everybody dropping dead in the street as occurred in the Middle Ages. So I know that governments are right now trying to establish, I think most governments are, I think ours is, I hope ours is. It can be a little unclear these days what our government is doing, but I think that they are now hopefully responding and trying to tabulate and keep figures on what mortality looks like. Transmissibility is troubling with this, because it spreads human to human contact surfaces, and we're all having now to get used to, do we handshake, do we peck a kiss, hello, do we hug? And new protocols are being established in our society as I speak, as to how people greet each other. And there's been runs on hand sanitizers, and will continue to be. So the virus is going to have an impact for a while on our social customs. And that was prevalent this past weekend at our event, as people were like, oh, do we elbow bump, and so on. Of course, events are being canceled now My daughter had her spring break scheduled. They still has her spring break scheduled for next week, and was going to Los Angeles for a softball conference tournament. And the one team canceled, and then the second team canceled, and then the tournament canceled. So this is going on. The South by Southwest conference in Austin, huge conference, canceled, which will put the organizers of that conference in very, very tough financial condition, which of course we'll be discussing the financial ramifications of this virus also. So it's highly transmissible, and is now being transmitted in the community. A community transmission is now in evidence. Began here in the United States in Seattle, and highly transmissible. The news today, or just now, I think I can stop my screen sharing here and go over. This is the live report. You all may have seen this, but Italy has now locked down. Let me refresh my here is Italy. Italy says it's halting most travel and public gatherings. It began as a restriction in just the northern part of the country. The outbreak there had been centered in Milan and is now extended to the entire country. So this is, as the New York Times describes, an extraordinary set of measures in a modern democracy that values individual freedom. So the entire country, 60 million people in Italy, as the government there takes measures that are very similar to those that have been taken in China, where the outbreak began to try to slow the spread of this virus. And the concern, as I understand it, is that there simply aren't enough facilities, ventilators and hospital beds and so on. If this thing spreads at a very rapid rate, there simply aren't enough facilities to get people into the facilities that they'll need. And so this is my understanding, that our modern healthcare systems are not set up to deal with such a massive, fast-spreading influx. And so it isn't necessarily that this is the most mortal virus, that we can conceive of or that we've ever seen. It's just the transmissibility. So let me go back to my slides. It's this rapid transmissibility and the asymptomatic nature often of people who have it. They don't know they have it. That is of the utmost concern, and why we're seeing these restrictions. The precedents, well, this is a coronavirus, COVID-19, and there is precedent for it. We have been seeing a succession of corona viruses. SARS, for example, a number of years ago, and there are others as well, including, what was the one that was really deadly? MERS, very deadly. So we have precedent for coronavirus. I guess that's the good thing, is that we've seen this type of virus before, and hopefully the scientists will be able to produce a vaccine. But estimates are that will be a year from now, and clearly the economic toll is mounting as that happens. I just talked about responses, and there are accusations that our government has been slow to respond, and there are accusations even that our government has taken measures counter in the early days of this, measures counter to what might have been the textbook measures that should have been taken and those prescribed by the professional medical and healthcare community. I don't know. I don't know, but there are indications that responses are now coming more rapidly, and there have been urgings, especially over the past week, by the World Health Organization and national organizations and health and doctors groups to speed the responses. Here in the United States, a lot of talk about how to get more test kits into the hands of people who need them. And of course, we're also seeing individuals take their own actions to stockpile food and stockpile, personal care products. I don't think our household has done any of that, but Hannah might correct me. I have to ask. We had a bar mitzvah to put on, so we were not in Costco. This is the response of financial markets today. And what you're looking at, and some of you I've shown this to before, these are the different sectors of the market. And so I'm going to activate my pen here, and hopefully you all be able to see this. So if I do this, I think you'll see a green, just testing my technology, you'll see a green circle I'm making. That's the technology sector, right? And here is the financial sector. And so the size of these boxes is correlated to the size of the market value of the company. So obviously, look how big Microsoft is, right, compared to AT&T, right? So that gives you an idea of who the really big players, most highly valued companies are in the market, and smaller players. Here is the services sector. And here is the consumer goods sector. Apple, debatable. Is it a technology company? Well, according to this map, no, it's a consumer goods sector. I think there's a strong argument for that, but why not put Google there or Microsoft? Anyway, my point there is that, look, these categorizations can be slippery. Think about if you took Apple and moved it over here, right? That would make this even bigger and this even smaller, right? This would become the consumer goods sector there, X Apple. But fine, we're not going to quibble. Here's Netflix. Is it a tech company or is it a services company? Is it Amazon? Is that a tech company? Well, 20 years ago you would have said it's a technology company. Now it's categorized as a service. So that's really how technology has really invaded all aspects of our lives. The news today centered around this sector right here. XOM is ExxonMobil, and CVX is Chevron. And it is under the basic material. So the first thing I want to note is, and obviously, look at all the red. This was a massive down day. I think the market finished down about 7%, right? And just to give you an idea of average daily volatility in the market, might be 1%. So we had volatility today of about 7 times what we might see on an average day. So a very, very volatile and a volatile down day. And this sector, this energy sector, the news broke overnight, and I believe, and nobody ever knows. I mean, you can watch all the news you want, and they'll say, well, the market was down today because of X, Y, and Z. But I don't think anybody can ever really say exactly, what accounts for all the movements in the market. My own belief is that this announcement overnight by Saudi Arabia that it was going to open the spigots on its oil supply. They are the low-cost producer still, despite all the advances that have been made here in oil drilling technology in the United States, fracking technology. Saudi Arabia, given its vast oil reserves that are relatively easier to get to, is the low-cost producer. And overnight, the announcement was made that an agreement had not been made by what is known as the OPEC 2.0, the modern OPEC, which includes Russia. Right, there's that country again, Russia, that is under the really the rule of Vladimir Putin, attempting to imprint itself in all areas of the geopolicy stage, did not agree with the desire of the Saudis to rein in the oil supply in response to the recent fall in price of oil, very drastic drop in the price of oil over the last few weeks, in response to the slowing of the travel related activity in this world, from airplanes to automobiles and so on. Remember, that is where oil is used. It's not really used in power plants. It's used in transportation. And transportation, the act of moving a human being to other human beings, is not exactly in vogue right now with the coronavirus. Well, Russia did not agree to rein in its oil supply. And the response of the Saudis has been, okay, fine, we're going to let you have it. So the market, I believe, today's downdraft was primarily related to that, not so much to coronavirus. Why? Because the market has known about the coronavirus now for many weeks. The market knows more about all of us on this call together, about how the coronavirus spreads, about where it is going to spread, about what actions are being taken in response. The market knows all that. And the market this morning, when it woke up and opened, knew all that. What the market didn't know overnight was what the response would be by the Saudis. And so today's movement, I believe, was the result of that. However, look at the size of the energy market. Look at the size, of the energy business compared to the size of these others. Think back to 50 years ago, right? And the energy industry, the oil and gas industry, probably would have been the biggest block on this map right here. That is no longer the case. Not only is it not the case, but it is dwarfed. And I believe that the energy business accounts for maybe 5% of the total of the S&P 500 in terms of value. All right. So I want everybody to realize the benefits of diversification and owning a portfolio that is closely resembling to the market, right? If you were way overweight energy companies, you lost 30% of your money today. I understand a 7% down day is a tough day. I get it. But if you were somebody, and there are many in Texas, many people in Texas who have learned the hard way and continue to learn the hard way, that is a tough business and getting to be a tougher business. All right, I think that's all I want to say about this slide. This comes to us from Yardeni, Ed Yardeni, a very famous and an excellent market guru. And if we take a look, this is 2019, all right? And this is consensus quarterly year-over-year earnings per share growth. Consensus of the analysts' estimates, the people who watch and calculate what the earnings for the S&P 500, and I could have shown you the S&P 400, the middle size companies. I could have shown you the S&P 600, the smaller companies, foreign companies, etc. Anyway, everyone watches the S&P 500. But take a look how, and each of these is a quarter, the first quarter for 2020. And what they're estimating is what will the quarterly earnings be here in calendar year 2020. All right, what will the third quarter earnings growth be? So it's not the earnings, it's the earnings growth year over year. Will it be 5% growth over the previous year, or 10% growth over the previous year? And here's the fourth quarter. So these are estimates that the analysts began to make in the second quarter of 2019 about what would the earnings be in 2020, right? A big forecast. Does that make sense to everybody? If it doesn't, send a text. But I'm trying to make this clear. So what were the estimates back here in the second quarter of 2019 about what the year-over-year growth was going to be here in 2020? Well, you can see they were up here 10, 12, 13, 14, 15%. Well, look where they are now. And here is the breakout of COVID-19. Q1, the consensus is now for bupkis. Q2, they're saying 5%, right? Q3, they're still optimistic. We'll get to 10% in Q4, but those estimates may come down. But look how, and then not only that, but look how the estimates have come down for earnings of the S&P 500 over time, over the last year. So earnings have been slowing. If the economy hasn't been slowing, then corporate earnings have been slowing. And I've been saying that on a number of our webinars, that we already have been seeing slowing of corporate growth. And this is what accounts for this, especially the drop this year of about 10%, and I'll show you this in a second, the drop in stock market values, right? The stock market value is driven by earnings and growth in earnings, and you can see that the consensus estimates have been coming down. All right, I'm gonna clear my drawing and go on to the next. This, also from Yardeni, is showing, this is a 7% growth rate is what this center line is right here, right? So they're showing you that on average, dating back to 1979, the average growth rate for the S&P 500 forward revenues and earnings, looking forward to the next 12 months, has been around 7%. And you can see that the estimates, right? These are the estimates, have been pretty good. Look at that, right? They're all kind of, sometimes they're too high, sometimes they're too low, a little bit too high here, right? But in general, but look what's going on here, right? The estimates are falling below this 7%, right? We're starting to see a slowdown and a slowing of growth beginning around 2011. So it's not a new thing that we've seen some slippage in the consensus estimates. The United States, remember, and the S&P 500 is, I'll remind you, a United States only index, large companies in the United States. The US is a mature economy, right? One of the reasons we diversified to things like emerging markets is that they're younger economies and faster growing economies. Yes, there are challenges right now, but the US is an older economy and it can only sustain a certain amount of growth. So this slide, again, to emphasize that we've seen some slowing. All right, now, the market fell a lot today. What was I doing around noontime today? Well, I met my dad for lunch. We had a fabulous lunch at Captain Benny's. Has anybody ever been there on Main Street? Old restaurants, fabulous. I couldn't resist. I had the fried shrimp. It was terrific. And then we met Leonard, yep, that's his name, Weissman. He is a physician and has worked at Texas Children's Hospital and done inventions before that have helped large companies put out products. He is working on, and my dad has made an investment before in, let me do the drawing thing here. They're making this gizmo right here. This is to test for infections. And the problem now is that this is the old thing, this package right here, and it's cumbersome and it's got to be frozen and it costs a lot to ship it. And so everything goes into this package right here, and it's got a computer with it that tells the physician, you know, the sample is good or it's bad. Well, why am I showing this to you? What I'm showing this to you is to remind everybody that in a down market like today, life goes on, business goes on. You know, Leonard Weissman showed up and we had a meeting to look at this thing, and who knows, this may become a big invention that becomes a foundation of an American company. And that is going on all over the country today, not just over by the medical center. And you may remember the old Nabisco building has been converted to an incubator for medical startups, right? So this was what was going on today all over the country. And everybody, you know, who could went to work. We went to work here. That is the backdrop of what is going on with the coronavirus and the market drop in the background. This is where the economic game is played. And so the economic game was being played today by Dr. Leonard Weissman. They didn't stop their innovation going on today. To the contrary, you know, they showed it to me and my dad during lunchtime or just after lunchtime. and they're preparing to launch this thing and may sell millions of units. It's going to really reduce the cost of detecting infection, and the first application is going to be for detecting Streptococcus B bacterial infection in pregnant women. So this is wonderful news, and I hope they're going to succeed at that. I want to remind everybody of Warren Buffett's saying, "Be fearful when others are greedy, and be greedy when others are fearful." Well, I haven't particularly liked the markets over the last year as everybody's greed thing came out. And it's been kind of a tough year for me and clients coming and saying, why don't you have me invested all in stocks? Why are you holding bonds? And I mean, I heard this over and over the last year. I said, well, we're holding them because something could happen. And to be greedy when others are fearful. And so as markets have fallen over the past few weeks, it's not that I'm feeling greedy. I'm just feeling more interested in acquiring stocks at lower prices. And as we know, bond prices have gone crazy. We're going to look at that in just a second. So this is history's greatest investor, Warren Buffett. So when he tells you something, you can take it to the bank. So if there's a lot of fear out in the market, you can just look at this saying and you can be assured that if you see a lot of fear, according to Warren Buffett, that's the time to be greedy. And over the last year, when everybody was acting sort of greedy, why do you have me in a diversified portfolio? Why don't you have me 100% in stocks, right? And when I hear those things, that's when I say, greed is out there roaming the landscape, and that's when I'm generally a little more fearful. I don't say I'm fearful, but just so everybody knows, I feel a lot better when prices are normalizing than when they continue to go up as they did over the last year, 30% over the last year. So that's sort of my mood. Now, you're going to say, well, fine, back it up. Well, here you go. I put in a number of trades today, not too many, maybe 3. For my own account, I had some money in a retirement account. And right here, you can see that I went ahead and I bought right here. This trade was for $5,000 for the DFA Global Real Estate Securities. Global real estate's actually held up pretty well this year, better than just the general stock market. And I generally put that into client portfolio. So I bought this. I bought some U.S. stocks and some international stock funds also. All the DFA funds that I tend to buy for everybody, I also bought for myself today. So am I putting my money where my mouth is? Yeah, you bet. There you go. You see it right here. I wanted everybody to see that I bought some for myself. I acted greedy today when others were fearful. All right. This should look familiar to you. This is the chart that I just showed you, but now rather than looking at what the prices of the stocks did today, this is showing you what the forward price to earnings ratio is. And as most of you know, a price to earnings ratio is the most basic way to value a financial security, including a stock. We can value a bond with a price to earnings ratio. We can value real estate investment with a price to earnings ratio. It's basically what's the coupon that you get for the price that you buy the security at. And when you buy a stock, that's what you're getting, are the earnings. And you can see, well, what's really the deep red one here with a price to earnings ratio. Let me turn on my drawing tool. Right here, look at Amazon, right? Okay, right? Look at Amazon there, right? So you can see the scale down here at the bottom, right? 30 is the nosebleed number, and here are the lower, more modestly valued parts of it. And you can see Amazon, 44.82 times forward earnings. Of course, earnings for Amazon are not always such a great indicator, because Bezos' strategy from the beginning has been to not be profitable. So that, in part, so they don't pay any taxes, but also so that he reinvests everything back into the company to try to get bigger and bigger. So you can't always look at PE as the be all and the end all, but certainly Amazon has a higher price to earnings ratio than, say, JP Morgan Chase. Look at that, 8.15. So there you're buying a security in JP Morgan Chase, which is more of a value stock, right? This is a value stock trading closer to its book value. It's a big bank. And this is a high-flying technology company trading at 44.82 times earnings. The big competitor to Amazon, of course, is Walmart. What's it trading at? I got to get this thing out of the way, this bar. Hold on, everybody. Okay, here's Walmart, right? Look at that. Who would have predicted back in 1995 when a little book startup online that it would eventually trade at a higher price to earnings ratio than mighty Walmart? Yeah, there it is. Walmart's not a shabby price to earnings ratio, 21.55. But here's the point. Look, you see a lot of green, right? I mean, look, green, 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 green. It's not like the market is massively expensive green. Look at the Cisco Systems. Remember in the tech bubble, that thing was trading at 50 times earnings, now at 11. Oracle, look at that, 10 times earnings. ExxonMobil, right? We know those are trading. Pfizer, look at a lot of green. So a lot of things are pretty reasonably priced, right? If something's trading at 10 times earnings, that implies that its yield is 10%, right? 10 times earnings means that if you take 1 divided by the 10, 1/10, right? That's 10%. That's about what you might expect the investment to return on average each year, say over the next decade, right? So that's what that means. All right, so just to give everybody a look at what valuations look like, yeah, there's some red for sure, but there's also a pretty good amount of green. The point here is that it's not that the entire market and that there aren't substantial parts of the market that aren't reasonable investments, you know, where you can make an investment and say, you know what, I can expect a reasonable return to come from this, for making this. So I want everybody to just keep that in mind. All right, next. I also want to remind, I always show this one too. I also want to remind everybody that there are times every single year, and I mean every year. Look at this, going back to 1980, but we could have gone back further. This comes to us from JP Morgan, a slide they like to use. What this is showing is that each year, what was the top of the market? What was the highest point gain-wise that the market reached? So in 1980, the market reached an up point at some point during the year. I don't know when it was, right? The chart doesn't tell us that, but at some point during the year, the market was up 26%, but at some point that year, it was down 17%. All right? Well, you might say, well, 1980, that year was special. Oh, yeah? Well, here's 1981. That year, the market was down. That was the best it did in 1981. Not a very good year for the market, because that was the best it did, -10 and -18. Next, oh, well, those 2 years were special. Really? How about 1982? It reached a peak up point of 15% and a down of -17. Next year, up 17, and so on and so on. And you can see that pretty much every single year, right, as I make a line through these, at some point, the market, look at that, down 49%. That was in 2008, right? At some point, every single year, there was a down, right? And here are the ups. I'll draw a line through those. So when you make investments in the stock market, look at this. Not a single up during those years. That was the tech bust, right? Way down here. And on average, the market has come out with a positive return somewhere around 10%. That's about what it's been. So we are down now, after today, let's call it 15, 16, 17%. Is that out of the ordinary? You tell me, looking at this graph, is it out of the ordinary? Because here is what the numbers are. All right, everybody? I want you to keep that in mind. Now, I'm not saying it's not going to do something different right now, or that it, you know, I can't ever tell you what things are going to do going forward, but I can show you what things have done in the past so that you can think a little more deeply about what's normal and what's not normal. Interest rates. Boy, this is a really, really interesting subject right now. And a lot of professionals are just not sure what to say about it, including this one, but I'll say what I can say about it. So this is, you know, this is interest rates and real 10-year treasury yields. Wow. We're going to take a look in a second at the 10-year treasury. 1958, going back a long way. So the blue is the nominal yield. The gray is the real yield. What is the yield net of inflation? Right? So as you can see, back in these years, there was no positive real return. This was when we had rampant inflation. Does everybody remember that in the 1970s, and gas lines and really high interest rates? So even though, look at this, look how crazy this was. Even though this year in 1980, I guess, it's about when Ronald Reagan took office, and you may remember rampant inflation, even though the interest rate of the 10-year treasury was around, look at that, it hit its peak, 15.84%. Even though you could buy the 10-year treasury bond at 15.84%, there was still no positive return because inflation was running at 16, 17%, 18%. We had 18, 19, 20% inflation, right? So you weren't even getting a positive real return, even though that's what the bond was yielding at the time. And that's what led Paul Volcker, who recently passed away, who was a great, great man, to raise interest rates at that time. Just taking a brief detour here to give everybody a little bit of a history here on interest rates so we can understand how we got to where we got today, right? Volcker took the step to raise interest rates at this point and just kept raising them until they broke the back of inflation by slowing down economic activity. And Ronald Reagan was not happy about that, these rises in interest rates. And I can tell you, if Ronald Reagan wasn't happy about it, if it had been Donald Trump, you can really be sure that he wouldn't have been happy about it and would have been tweeting about Paul Volcker. But at that time, it was generally the practice that the President of the United States sort of let the chairman of the Federal Reserve do his work. And do his work he did. Because look at the trend of interest rates, both nominal and real, over the last, what are we, almost 30 years. Almost 30 years we have seen a decrease in interest rates, right? And we have culminated this week, today. Today, as I speak, we have culminated. This chart is only through December 31st of the year just ended. It does not include activity that has occurred this year. I'm going to show that to you in just a second. But look at how interest rates have fallen. And as interest rates have fallen, what that means is that bonds have risen in value, because bond values go inversely to bond rates, right? As rates, let's just say this is rates. If rates rise, the value of the bond goes down. It works like a teeter-totter, right? Very important for everybody to understand how bond prices work. And conversely, if rates go down, right? I'm sorry for my handwriting. It's bad, and you can imagine it's even worse trying to write on my screen. As rates go down, bond values go up. Well, look what happened here for these years. Rates went up, so bond values were going down all this time between 1958 and 1978. If you own bonds between 1958 and 1978, you lost money, generally speaking, because of the direction of interest rates. But look what's happened over the last 30 years. If you own bonds between the time Paul Volcker broke the back of inflation and today, and I mean today, March the 9th of 2020, you made consistent money in bonds. And the longer the bond duration, say the 30-year, which is pretty much the longest bond duration that we know, although there are now bonds that have been issued 100-year bonds. The country of England, I think not anymore, but they used to, back in colonial times, issue 100-year bonds, which I think have actually turned out to be pretty decent investments. I forgot the name. It's got a name like the Excalibur or something like that. But if you held a 30-year bond versus a short-term bond, you've made really, really good money probably 15% a year. If you own the 30-year bond, the 10-year bond, sorry, because we're looking at the 10-year, but if you own the 30, you've made even more. But what do we do now? Because let me show you. How do we think about bonds now? Here is the Treasury yield curve. Just to orient you to this, all right? In March of 2018, that's the square, the line with the squares right there. So what this is showing you is that in March of 2018, the 1-month Treasury bond, which is pretty close to cash, had a yield of a, what is that? This is 1.5, so call it 1.7, something like that, right? We'll call that 1.7. In March of 2018, the 1-month Treasury bill, it's actually called a bill, not a bond. We don't really get a bond until we get to a year. Anything less than a year, we call a bill. Yielded 1.7. Well, here we are. This is as of Friday, I believe. But whatever, it's recent, whatever it is. As of now, the 30-year bond, the longest Treasury bond that is issued. The Treasury was actually going to get rid of the 30-year bond a few years ago, but that decision was eventually reversed. The yield on the 30-year Treasury bond right now, right, because the blue line is now, is showing 1 point, what is that right here? 1 point, call it, no, I'm sorry. Yeah, 1.3. I don't know, call it 1.3. It may be under that. I don't know if that number is right. Okay. So what does that mean? That means that in the last 2 years, the 30-year Treasury bond going back to March of 2018 was yielding 3%. In the last 2 years, that yield has been cut more than in half as interest rates have fallen. Now, why does Warren Buffett say, I can never guess interest rates? Right? All the interest rates, whether it's the 1 month or the 3 month or the 1 year or the 2 year, all these different interest rates have all fallen, right? You can see that. It's very clear. Very clear. It doesn't matter what the length of your bond, whether you hold a bill or a bond, or it's a 10-year bond or a 30-year bond or a 1-month bill or a 1-year bill, you can see that interest rates have fallen. And Buffett has always said, I can't predict interest rates. He also says that even if the Federal Reserve Chairman were to whisper in my ear what they were going to do with interest rates, it wouldn't change a thing that he does. Meaning the Federal Reserve controls the short end of the curve here. This is what the Fed controls. Okay? The Fed has no control over this stuff. No control. The market sets these rates, everybody. When you hear the Fed changed interest rates, you can put your mind on this, but don't think that the Fed has any control here. The market sets those rates. So Buffett says, I can't tell you what interest rates are going to do. And he means it. Why? If you go back 2 years, right? Everybody said, oh, the 10-year Treasury, right? And the 10-year Treasury is generally regarded as the most watched interest rate in the world. It's considered to be the risk-free. Here it is, the 10-year. It's the one. It's the risk-free instrument against which all other investments are measured, right? What is the yield on stocks versus what is the yield on the 10-year? That's called the spread. What's the spread between this instrument and the 10-year? What's the spread, right? Is it wide or is it narrow? Gives an indication of how risky something is versus the 10-year, which is regarded as the standard in the world of a security that will be worth its money when it comes due. Now, I know we could get a lot of arguments about whether the United States government And the country of the United States right now is that good. But that's an argument for another day until it's sort of decided otherwise. The 10-year is that instrument. And in 2 years ago, March of 2018, I can tell you that there was plenty of talk at this point that the 10-year Treasury bond at that time at 2.7% cannot go any lower. All right, everybody? I can tell you, I heard that over and over and over again. It can't go any lower. Is that right? Because there we are. And today, so this is, I think, Friday, this was around 0.7%. So that 2.7% became 0.7% on Friday. And today, I believe, with the big downdraft in the stock market, I think today it's around 0.5, a half of a percent. A half of a percent. Now, let's talk about what that means. Do you, dear clients, do you want to loan your hard-earned money to the federal government for a decade? It will be locked up, okay? Do you want to loan your hard-earned money, your wages and your savings and your investments to the federal government of the United States for a decade to be paid a 0.5% a year? If you do, please send Catherine a something right now. Yes, I want that. Just, I'll get back to you after the thing. I'll call you tonight, the morning. You tell me when you'd like me to get back to you if you want to take that deal, because that's the deal that is on offer today in the marketplace. A 0.5%. Let me put it to you another way. What that investment represents, when we talk about stocks trading at 10 times earnings, right? That means that you buy the stock for $100 and it earns $10 a year. And you, as one of the shareholders, are entitled to the $10 of earnings on that share that you own. That's 10 times earnings. This instrument means that you purchase the bond at $100 and you get paid 50 cents, not $10, 50 cents. So what is the price to earnings ratio on that investment? Anybody? Go ahead, type it in. I don't know if I can see it. Who knows what here's the trivia question. What is the price to earnings ratio on a bond that is yielding a 0.5%? Anybody? How do I get the answer, JC? I mean, do I open the poll up to people? What people can type it in, right? Or they can't. Are we getting any answers on that? Can we open the chat to them? Let's open the chat. Anybody want to tell me, please? We getting any responses on what the price to earnings ratio on a 0.5% bond is? Nobody? All right, I don't know if it's technology or I've stumped you. Here it is. $200. Let that sink in. The 10-year Treasury is trading at 200 times its earnings. And yet people are selling JP Morgan today that is selling at 8 times earnings. Now, I remind you, it wasn't only people selling JP Morgan today. I was one of the people buying JP Morgan today and not buying the 10-year Treasury because I would rather buy my investments at 8 times earnings than at 200 times earnings. But you may be different. That's fine. Let me know if you want that deal, the 200. Okay? So this is the problem. In 2000, during the tech bubble, stocks were very expensive. They were trading because people had bid up the prices of things like Cisco and Dell and so on. You know, the S&P 500 was trading at 35 times earnings, right? That's a lot. That's a lot bigger than 8 times JP Morgan, and it's a lot bigger than the 15 that we're trading at right now. Although I agree with you, and you can say to me, yeah, but earnings are falling apart and the world's falling apart. Coronavirus is going to destroy every company, and there's not going to be any earnings, and Disney Cruises is going to shut down. I get it. I understand. Okay, we don't know where earnings are going. I get it. But we're a long way from 200 times earnings, and yet people want the 10-year Treasury bond. As your advisor, I am now facing the question of what do I do if there is any of this in the portfolio? It has done very, very well for you. And I will point out that I was not one of the people saying rates can't go any lower back 2 years ago. And in fact, we bought government bonds for you at this time. And look, they've done very well for you. Because I was worried that we might get this, something in the Trump era. I didn't predict it was going to be a virus coming out of China. But when rates got to 2.7%, I said, well, let's own a little bit as a hedge. And so your bond positions, if you have some, and if you're an aggressive investor or a younger investor, you may not have many in bonds, but those of you out there who have bonds in your portfolio, believe me, they have done their job this year, and you know it. So hopefully people won't carp at me too much in the future. Why do I hold these bonds? Well, now you know. For just these moments. All right. Boy, look at that chicken scratchings. It's got to be a record. Okay. Let me move on to the next slide. Really took a long time on that one. Darn it, man. Mouse buttons. Okay. All right. What have returns looked like year to date? What have they looked like year to date? Let's ground ourselves in what things have done. This is sorted by descending order from biggest gainers on the year to biggest losers. And I have also thrown in the 1 year, 2 year, 3, 5, and 10 year performance as well, so you can see that. Gold, right? Gold always does well during these times. I've never been a big fan of gold for many reasons. Gold doesn't have an expected return. Again, I cite Buffett a lot, but Buffett in many ways was my mentor, not because I knew him or he taught me personally, but he's been so generous in his writings. And the first place I turned to learn about investing was Buffett. And by the way, there's if you have the time and the interest, there's a 2-hour interview that Buffett gave just the other day to Becky Quick of CNBC, and you can get it on YouTube. It's 2 hours, but it's a phenomenal interview. And he's not going to be with us much longer. We don't know how much longer. I would doubt if he makes it another 10 years, but he might. And he is still dispensing the greatest wisdom about investing. And so if you are interested, you'll find it. It's a 2-hour interview, and it comes right up. It was just recent. Buffett has talked about gold, and he said, well, if you want to talk about gold as an investment, think about it this way. You could take all the gold in the world, all the gold that has ever been mined and is existing in all the vaults, and you could melt it down into a single cube. And that cube would fit in the infield of a baseball field. All right? And when the price of gold gets high, as it is right now, you could take that cube and you could trade it for all of the arable farmland in the United States, all of it, plus something like 10 Exxon Mobils, plus another $1 trillion of walking around money, or maybe it's a bill. I forgot the number, billion, two, but some large amount of cash. Which would you take? The big cube that you could what? Make human sacrifices on top of, or pray to, or what? Or would you take all the arable farmland in the United States, 10 ExxonMobils, right, enough fossil fuel hydrocarbons to fuel you for eternity, and a bunch of walking around cash valued in the billions? So that's the problem. It's very hard to know what is that big cube worth. Nevertheless, year to date, gold up 9.7. So whenever a client says, you know, I'd like to hold some gold, I never argue. I say, fine, I'm happy to buy some gold for you. But I never buy it just to buy it, because over the long term, it has no expected return. And it hasn't had any long-term return dating back to decades. Next, look at US bonds, 5.7%, almost 6%, and we are in 2 months into the year. There it is. Look at that. So your bonds have stood up in this recent downturn. Global bonds also have done well, 4.4. The conservative portfolio, this is just sort of a notional conservative portfolio, 2%. So if you own a conservative portfolio, maybe you're up a little bit for the year. Inflation, still very quiet, 0.2% on the year. A moderate portfolio, you might have expected to lose maybe 4%. U.S. REITs, real estate investment trusts, held up not too bad, down 4%. Stocks, U.S. stocks down 8%. Aggressive portfolios, right, which did so incredibly well last year, right? Everybody wanted 100% stocks at the end of 2019 and told me so. Uh-oh. Where are all you folks who want the 100% stock portfolio now? I don't know. Maybe there's some of you. A lot of you said, I want to buy a lot right now. So maybe you're consistent. Emerging market stocks a little bit worse, but interestingly, emerging market stocks have really held up much better over the last couple of days or last week or so than developed economy stocks. Maybe some indication that we're seeing a bottom in those stocks. They haven't done well over the last few years, but they're priced more attractively. But of course, you know, who knows where the Chinese economy goes right now, right? Who knows where the Russian economy goes right now, given the fact that it's now at war with the Saudi economy? Who knows where the Brazilian economy goes? International stocks down 10%, but all the stocks are down 8, 9, 10%. Look at commodities. Boy, commodities have just been destroyed in the last decade or so. Just walloped. That's oil. Look at that. I promise you, there are a lot of hurting people in Texas right now. My job is so that my clients are not hurting like this. That is my job to you, to make sure that you are not exposed to this kind of thing right there. All right? So I know nobody's happy. I get it. But, you know, there are a lot of Texans who love their oil and love their oil business, and they're getting walloped. I try to keep you away from the walloping. All right. Let me I got to clear the screen again. Where is it? Clear. I think I know right where it is after all this, but I still fumble for it. All right. I've talked a lot on webinars about growth and value stocks, and people have also complained about that. Why, you know, the portfolios I put together for you are they have both growth stocks and value stocks. It's not one or the other, it's one and the other. The portfolios tilt a bit toward value stocks. Why? Because over the long term, by far, they have given a higher return, noticeably higher return, about 2% a year, but they haven't recently. And you can see that in this chart. Last few years, they haven't. But take a look. And again, I showed you JP Morgan. It would be considered to be a value stock, trading at a low price to book ratio. So what does this chart show? Going back to 1964, this is the average, this is the price to book. What is the price to the book value of the company? The book value, to remind everybody, is what the accountants say the company is worth. We add up the assets on the balance sheet, we add up the liabilities on the balance sheet, we subtract the liabilities from the assets. What remains? The book value of the company, the book value of the equity. All right? And the market value, though, is different. The market value of a company is different than the book value. The accountants may say that the company's worth one thing, but the market may disagree. We know you accountants say that they've got some cash and they've got some accounts receivable and they've got some plant, property, and equipment. We don't care. We don't think that reflects the true earning power of the company. And the example I always give is if you go back to 2008, a company that had a really low price to book ratio was the Bank of America, right? It was just about going out of business. It had acquired Countrywide Mortgage. The mortgages were not worth what the accountants said they were, and the liabilities weren't worth what the accountants said they were, because that company was about to be sued up, down, and all around by the Federal Reserve Bank, by big mutual fund companies like PIMCO and BlackRock. In contrast, Apple Computer had just released the this thing, right? Everybody can see my phone, right? And they had just released this, and the market said, well, we know the accountants say the company's worth whatever, $20 billion, but we think the company's worth $200 billion or $300 billion because they're going to sell the hell out of this thing. And in fact, the market was right. So the price to book ratio for value companies, you know, has been around this, consistently around 1. The price to book of growth companies, this is gray, this line right here. Look at the volatility, and look at this peak that was hit right here. That's the tech bubble, right? 7, 8 times the book value. The accountant said the company was worth 7 times. No, I'm sorry. The market said that the company was worth 7 times what the accountant said the company was worth. The growth companies back in the market was saying, we know that you accountants are telling us that Enron and WorldCom and Cisco are worth X, but we think they're worth 7X. Well, look what happened. Guess the accountants were at least a little bit right about that one, because we hit that point, and it's not like that went on for a while. It was a cliff, right? And look at the blue line is the spread between the gray line and the between the dark gray line and the value, right? And you can see how the spread widened there. The growth companies got much more valuable, big spread between the difference between the value, the market value on the value companies and the market value on the growth companies. And look where we are now. After several years of Microsoft and you know, Facebook, I mean, really several big companies, Amazon, it's starting to look suspiciously, isn't it, like that moment in time? Everybody's forgotten about all these companies. And in a way, the coronavirus kind of reminds us of that, because which companies is everybody wanting to buy right now? Procter and Gamble. Everybody wants some bleach right now, right? Everybody wants beans and rice. Although I think that there are a few tech companies like Zoom, which we're using tonight. The software we're using tonight with you is Zoom. Zoom's a publicly traded company, and I think its stock has done well. Netflix, I think, has done well because people are no longer going to go to the cinema, right, where they could get coronavirus from the seat or the person next to them if it's a real popular movie, right, and it's sold out. It's the guy behind you sneezes on the back of your head or something. So Netflix, I think, has done pretty well, reasonably well. I'm sure it's lost a bunch of money, market value, but everybody's going to, right? What's the new world? We're all going to be sitting home, video conferencing with each other and watching Netflix. So this slide is just to show patience, please, everybody. It takes some time sometimes for value to reassert itself. And the average over time has been about 3. That's been the average spread, right? This dotted line right here. Well, we're at 7 or 6. So if you believe in reversion to the mean, and I do, we would expect this spread to come back down at some point. And it may be coronavirus that triggers that. It may not be, but it might be. So patience. Your portfolio may outperform benchmarks. It may not, but I want you to see the underlying basis for why I say it well might. All right, that was a pretty long discussion about that. But now, today we had the oil stocks really get a whomping. And I think most everyone knows that I invest in sustainable funds. If you want that, I don't push it on anybody. A lot of our clients are inclined in that direction. if you want this, and I've said it many times, if you want this, just let me know. And a lot of more clients are saying, yeah, I'd like to have this. And I can, in your IRAs, I can switch you out of the regular core funds with no tax, right? Because there's no tax in the IRA, right? The core portfolios. This is the U.S., right? We also have international and emerging markets, and I can switch you out if you want to have the sustainable core fund rather than the regular core fund. I can do that, and there's no cost. Now, there may be a tax problem in your taxable account if you have taxable accounts, and many people do, and we have taxes that are appreciated. But with the fall in the market right now, if you want to switch over to sustainable, now might be a good time because we've had a decrease in the values. So that's something that you may want to think about. Now, the way that DFA goes about this is a way I really like it. Rather than saying we're not going to hold any coal companies or we're not going to hold any oil companies, they don't do that. What they say is we're going to create a portfolio that's going to represent a big reduction overall in the overall profile of emissions. So if you want lower profile, if you want lower exposure to emissions because you think that, well, number one, it's just your values dictate that. Mine do. Yours may. They may not. That's fine. Either way, I don't force that on anybody. But the portfolio represents, and the sustainable portfolios came out just a few years ago. The sustainable portfolio versus the core portfolio is an 81.2% reduction in emissions. That's what it represents in the companies that are held in that portfolio. I mean, I don't know what much more you can ask for. Is there a coal company in the portfolio? Maybe there might be, but the goal of the portfolio isn't to necessarily banish certain industries. It's to give you, and I think this is a smart way to go about it, because do we need metal mining? Well, yeah, if you want solar panels and you want buildings, we're going to have to mine for metals. But so the goal of the portfolio is designed to represent a reduction in greenhouse gas emissions, and also a reduction in potential emissions from reserves. Look at that, 99% down. So if you feel, and a lot of you already hold this sustainable fund, but if those of you out there who don't, you want it, let me know, and I can put together a plan to get you there. And I simply bring this up because on a day when we see that energy stocks are down big, and there are questions about the future of oil companies as the world grapples with climate change. So I wanted to throw that slide in. Just let me know if that's if I'm not already doing this for you and you want it. That gives you an idea. Now, the next question always on the sustainable portfolios is, well, what price do I have to pay in performance? You're going to give that to me, and but you know, then I'm going to pay in performance. Well, the history is actually quite good. So this is the U.S. fund, this is the international fund, this is the emerging markets fund. So 3 different funds in different parts of the world. The U.S. versus the Russell 3000. Here are the benchmarks that they're benchmark. Each of these is benchmarked against a different benchmark, right? Here in the U.S., this is the Russell 3000 index, which is the total U.S. market. The performance of the U.S. Sustainable Fund versus the Russell, well, it actually beat it by 1.5% over the 1-year period. About even over the 3-year period, very close over the 5 years. So the point here is that, and same sort of story here, beat it here, but it's close here. There's really not much of at all difference in the performance between the funds. So you don't have to worry about that if you want to hold those sustainable funds. The performance of these funds is engineered to be very comparable. All right, clear all drawings. I think I'm getting toward the end here. Yes, I am. Okay, so what are responses to all that's going on? Well, in the bond, I talked a lot about bonds, right? I spent a bunch of time on that slide. Duration represents, so what is the duration, everybody? Here's another trivia question. What's the duration on a 10-year treasury bond? Take a wild guess. Anybody? It's 10. The duration on the 10-year treasury bond is 10. Well, what's the duration on your bond holdings? Well, it's a little trickier, right? Because you hold a municipal bond fund and you hold a government bond fund, and you may hold a corporate bond fund. And so what we do is we put it all into a blender. We blend it all up. And so what's the duration on that? Pretty much the portfolio I run for you is somewhere now between 4 and 5, right? And why is that important? That means that for every 1% rise, right? And again, we're back to the teeter-totter. If we get a 1% rise in interest rates, you'd expect to see a 4 or 5% decrease in the value of your bonds. Well, this year, we've seen a 1% fall in bond prices. So you've gotten a 4 to 5% increase in the value of your bonds, which is exactly why when I showed you what returns have been on bonds this year, it's been about 5%. Okay? But now the question is, now what? Now when bonds are all yielding under 1%, do I keep these bonds for you? Do I sell them for you? I'm doing a lot of wrestling with myself about this. And I may reduce some duration. I may sell some of these bonds. And I may also add some additional inflation protection in the bond portfolio. Why? We didn't have inflation protected bonds before the 1990s. Inflation protected bonds were created to help investors fight off the effects of inflation. And the way it works is that every year the government has to make a payment to you to make up for any unexpected inflation that occurs. Well, we're in kind of a weird time right now, inflation-wise. There's not much to speak of. And over the last week, there's even less because oil prices have totally plummeted. And oil prices play a very big role in consumer inflation. But we're also seeing price increases in stuff like well, Clorox bleach, probably. I don't know. I'm guessing. I haven't been to the store. I worry about inflation in a world where we may be facing supply cutoffs and supply chain disruptions. So these are the two things I'm thinking I'm in a really big, deep think right now about do I do some reduction in bond duration, because how much lower can they go? Well, they could go negative. As many of you know, we have negative interest rates in Germany and in Japan. You know, are we going to go under zero here in the United States with a treasury bond? I don't know. Stocks. I had only one expression by 80 different client households today. Only one from a single client wanting to sell. Meaning not only wanting to sell something, because I only got one call or one notice from out of 8, and and that may be the right answer for this client. I'm not saying it is, it isn't. I'm not saying, I'm just trying to give you a sense of what is the client pool of new capital saying to me so that you know. And the only indication of any desire to sell anything today, anything, was from one client who wanted to sell everything. So the other 79 households, pretty much not a peep. One client, we were going to increase some stock holdings. They asked me to hold off, but they did not ask me to sell anything. So the only indication of a sell came from one client today. That's it. Now, again, I'm not saying this, this client could be a total genius, and no, clairvoyant about, no idea. I can't tell you what's up ahead, but I am just telling you that people are staying in their seats. However, sales for necessity, if you need cash, and you don't think that I've adequately put in enough conservatism, and that would be represented in the bond portfolio. Let's have a discussion. Happy to have it. And in stocks, I'm looking for adding on weakness, if anything, because let's think about this. A 60-40 portfolio, classic balanced portfolio, stocks. Let's say stocks do 5%. Let's say everybody says, all right, earnings are going to fall, coronavirus, Disney's not going to ever hold another cruise, and nobody's going to go to the theme parks, and blah, blah, blah. And stocks on average are going to do 5%, including international stocks and everything, right? So if you multiply 60% times 5%, what do you get? You get 3%. So that's the contribution of the 60% stock part of the portfolio, 3%. Now the bond portion of the portfolio, 40%. Well, what are bonds going to yield going forward? Anybody? You tell me. The 10-year treasury now is under 1%. The benchmark bond in the world is now under 1%. Fine, I'll give you 2%. We'll throw in some higher yielding corporate bonds, and we'll throw in some foreign bonds, and we'll say that the bond portfolio is going to earn 2%. So what is that? 40% times 2% gives what? 0.8%. So a 60-40 portfolio, 3.8%, everybody. Okay? So why do I want to add to stocks on weakness? Because that's where the return can only come from. It can't come from bonds anymore. I don't think. They could get cheaper. I guess they could go under zero and we'll continue to make money on bonds, but I don't know how to make that bet in my own portfolio, and I didn't today. I showed you the screen of me buying some stocks. I was happy to do it. The market gave me 7% off today. Fine, I took it. I wish that I bought a new suit at Joss A. Bank. I know, I don't know if it's a good place or not, but I bought a new suit the other day. And that place, right, you have to go in when they're giving the deal. It's all about the deals at Joss A. Bank. Well, I had to go in, and I've been so busy, crazy busy leading up to the bar mitzvah, that I walked in on Thursday night and I needed it for Friday for a Saturday morning ceremony, and there was no deal. And I can tell you that I would rather have gotten my discount. I got my discount today in the stock market, you know, and I've gotten some other discounts over the last few days. So I'm looking to add on weakness because this is where the return is going to come from. There's no way to get a return here. Mortgage refinancing. Everybody who hasn't should at least take a look. I took a look at refinancing my mortgage. It's not a slam dunk for me. Why? Because when rates were really low many years ago, right, coming out of the 2008, 2009 crisis, I did some refinancing, and mortgage rates have been low all along the way. So you may get something more, you may not. By the way, what a lot of banks are doing right now, because they compete with new capital, is they'll say, we'll give you a lower rate if you move your money over to us, or move $500,000, right, JC? That's kind of what they're doing. And we're happy to do that, okay? What they'll say is, if you just move the money over and keep it until we do the mortgage, you can move the money back to your advisor, whatever. We're happy to do it. We work for you. So don't feel bad if you get a good offer from Wells Fargo, and if you move some money, whatever, $500,000 in an IRA or whatever it is over to them, we're more than happy to help you do that. Please don't feel bad about that. We would like you to move the money back again so we can continue to help you, but we're happy to facilitate that, because that's what they've been empowered to do by the federal government, is to use their leverage in the mortgage market to exert marketing pressure in the wealth management area. But that's fine. You come first. So don't let that stand in the way. Other responses, your personal risk tolerance and planning review. We are having a lot of meetings. I mean, lots and lots of meetings with clients coming in. I've been so busy with meetings, and I've been very happy to do it. We can always retest your risk tolerance using our Riskalyze tool. Some people like that tool, some people don't. I like it. It's not the be all and end all, but it gives us a good indication about what you're feeling about risk tolerance. And I can send it to you, or JC probably will send it to you over email if you want to take it from the comfort of your own home. We can also do a video conference with you and take you through it. Happy to do that as well, either way. And we'll get a nice score on you and update your score. And maybe your risk tolerance is more or less, or maybe it hasn't changed, but at least it's something we can do to do some testing. And we can also always do a planning review to make sure that you are in good shape, even with a fall in the market, and we can stress test. So we are always available to do that. We're quite busy right now and booked up. I've got spring break next week. I'm going to go to Colorado right now. That's the indication. We've got airplane tickets. Who knows if that changes and it's all going to go on lockdown? I don't know. But right now we're excited about that trip. But we will work you in however we need to. And then, of course, on the virus itself, we all are just going to have to continue to take in information and take prudent measures as much as we can. I will tell you this. I have asked 3 people in the last few days the following question. Is this overblown? And these are the responses I've gotten. I'm going to tell you about each person I asked, and I haven't been asking people that I didn't want to get an answer from. I understand that the President of the United States thinks it's overblown. I rarely, if ever, agree with the President of the United States, and that is well known by everybody on this call. But this may be the first time, oddly enough. I know that everybody else is sort of like, well, I think we're not so sure whether he's telling us. So I asked 3 people. The first person I asked is my good friend Andy Lee, who is a PhD physicist from the University of Texas and knows just about everything about everything. Andy, is this overblown? And his response was instant. Yep, it is. I asked, who else did, oh, shoot, who was the second person I asked? Darn it. Well, I asked the guy whose picture I showed you working on the bacterial incubator product, Dr. Leonard Weissman. I asked him today. Again, it was an instant thing. Neither of these people even had to think about it. Immediately came back and said, yes, it's overblown. And when they say overblown, they don't mean that it's not a real thing. They just mean that the response is so extreme in the face of something that if we don't understand the full ramifications of this virus, that at least has some familiarity to us in terms of how to craft a response. And both of those people felt that it was overblown. And I'm sorry, I don't remember who the third person I asked was, but they're also, oh, yes, I do. This is a friend of ours, Drew, who works at the Center for Disease Control and lives near us and was a neighbor of ours on Bank Street. And Drew is a public health expert. I mean, of all the 3 people I asked, he is the man. And he is with CDC. He goes around and works on public health crises and issues. And he also gave a very, very quick answer. Yes, there are many overblown elements about this. Now, I'm not saying that this isn't a real thing and that people aren't taking prudent precautions, but I'm trying to keep your investments and your wealth in the context of what people who I trust, and I mean really trust, are saying about the challenges that we face from the virus. Finally, and then I'm going to wrap it up, and I know I've gone really long tonight, but that's okay. An hour and a half. The world and the market has always faced challenges, always. Think about it. We've had a world war when every nation in the world was trying to kill the other nation, and the markets went on and, in fact, did pretty good. We've had depressions. We have had just about anything that you can name, and you have been rewarded for continuing to hold your investments. I don't think that anybody out there, if you're retired, well, this doesn't apply to you, but let's say you are still working or you own a business. I don't think anybody's response to the coronavirus out there is, I'm going to sell my business. Is anybody out there responding to the coronavirus that way? Well, I got to sell my business. Well, I got to quit being a doctor. Well, I got to quit being an attorney. I got to drop out of my law firm. I got to sell our factory. Coronavirus is here. Right? And I want you to think about your stock holdings the same way. You're a shareholder in businesses. You can sell your house because of the coronavirus. So I don't want you to think of this as, oh, the market's down, I got to sell my stocks, because what you're really saying is I got to sell my businesses, because you own thousands and thousands of businesses across the world. Okay, I think that's enough. We'll take some questions. I'm sorry I've gone a long time tonight, but I just wanted to make sure I had my say. And we'll continue to do these as necessary, but I did want to get on the record tonight. So what do I do? Annotate. I got to clear my, what do I do, JC? I got to clear all my junk. Catherine, I'm going to let you jump in here and sort of help me climb down from the mountain here.
Sure.
Clear.
We've got a few questions that have come in, and I'm going to start with the first. It actually came in.
What do I do with the screen here? Do I get out of, do you take it over now?
You can leave it there.
Leave it on this screen? Okay. All right. Okay.
Sure. So the first question came in before the webinar began, so we'll touch on that. It says, if you had to invest the 2019 S&P contribution of a 60-year-old working woman today, would you buy stocks on this dip or keep it in cash or something else?
Okay. Are you healthy? You know, you're going to live a long time. The actuarial figures, if you're healthy, say that you've got a really strong chance of living till you're 90. That's 30 years from now. 30 years is a long time. Do you want to hold cash? Do you want to hold a 30-year treasury bond at 1% and earn 1% where inflation, even though it's low right now, on average has run at 3%? On average since the 1920s. It's your SEP. Do you have assets in other places? It's not a simple question. Everybody's different. But all things equal, I bought stocks in my SEP today. I'm 54. So that should give you some indication of what I did today. And that might give you some indication of what I might be thinking about doing for you also. The problem right now is that the alternative to stocks is really, really dismal. Back in the tech bust of 2000, the 10-year treasury bond was yielding 5.5%. So if you did not like what the stock market was pitching at you at that time, a lot of people did, right? A lot of people bought WorldCom and all that. And just to remind you, the NASDAQ from its peak collapsed in value 78%. The NASDAQ, not the market, not the whole stock market. Remember, the NASDAQ, especially at that time, was a tech-heavy stock market index. Exchange, really. It's not really an index, it's an exchange. So if you didn't like the prices of the WorldComs and the Dells and the Cisco Systems at that time, you could just walk out of the room and walk into the 10-year treasury room and buy the risk-free instrument at 5.5%. That is no longer the case. So I would at the very least be thinking very strongly of adding to a stock position, assuming that your position is not already very overweight in stocks. You know, if it's very overweight, then you might just say, I'm going to stand put, stand pat. But we can talk about it. Okay, next question.
Okay, jumping back on, question specifically about BRKB. How is BRKB down so much?
Well, I own a lot of Berkshire. Berkshire had a tough year last year compared to the market. The market, the U.S. market was up 30%. Berkshire was up 10%. Right? Normally you go 10%. Good return, but nobody's happy with 10% last year, right? Everybody wanted 30%. And Berkshire often lags, and not everybody owns Berkshire. I put it in some portfolios, but I don't put it in all for various reasons. But Berkshire often lags a really strong bull market. And Buffett will say that, you know, when the market's hitting lights out, don't expect us to keep up. But it often outperforms when markets are down. I don't know that that has been the case this year. I do know that it was the case today. I think Berkshire today, even though the general market was down about 7%, I think Berkshire pretty much was even for the day. I could be wrong. Let me check. What did Berkshire do today? Let's look together. No, down 6% today. So it was down in sympathy with the market. I don't know exactly why. Berkshire is the largest shareholder in Apple. It owns anywhere from 5 to 10% of Apple. And my guess is that Berkshire has been buying because he's got $120 billion in cash. And I can assure you that during this downdraft that we're getting, Warren Buffett and his team are out there buying stocks. I promise you. I'd be shocked to the depth of my soul if they were not, if they were not buying. It would stun me. It'd be the most surprising thing you could ever tell me about Warren Buffett if they were not acquiring during these big downdrafts of the last few days. But they have big holdings in Apple and big holdings in banks. They also own insurance companies, and it could be that, and they are the reinsurer of last resort. It is such a strong company financially. It is the Fort Knox of the insurance business, and they reinsure a lot of risk. So I don't know if they have some coronavirus related exposure through the insurance subsidiaries or not. So I'm not exactly sure, but I am not worried about Berkshire at all. And my money is where my mouth is. I own a lot of it. My family does too. We haven't sold any of it. None. Zero. Now, I have donated some of it to my charitable fund because it has appreciated so much since I first bought it. So I will use Berkshire, and I fund my charitable account, and we've opened charitable accounts for many of you. So just so you know, I want to give you full disclosure. I have parted with some of my Berkshire stock in the past, but it hasn't been to sell it to get cash. It's been to give it away for charitable purposes. But again, any of these questions, if I don't fully answer your question and you want to follow up, just let me know and we can get on the phone together. Okay, next question.
Okay, next question. Given the drop in stocks, would you consider selling bond and buy quote unquote green stocks? Most of us don't have large cash holdings to invest in stocks, so the only way I see is trading bonds for stocks.
I think I've answered that in this call. I'd say I think considering is at least something that we should do. Considering, it's something I'm considering. It's been a 30-year bull market, as I showed you, in bonds, and once you hit 1%, under 1%, it's hard to know how much. It's hard to see that there's much juice left in that lemon, right? So I think consideration, but for us all to do that, if we're all going to do that, and I'm not saying we're all going to do that, I'm just saying for us to do that, we all have to accept the volatility that could come with stocks. I can virtually assure you, unless this is the end of the world that the virus is bringing, that over the long term, we are going to do better and probably much better in stocks than bonds going forward. But you got to say, all right, I'm up for that ride. And you may not be, and that's perfectly fine. You may say, you know what? I like 50% in stocks and I like 50% in bonds, and I don't care if the bonds don't make me any money, and our financial planning work together may show you're fine. If you don't make any money on bonds, you're good, and we're not going to worry about it. But don't come to me when the stock market barrels ahead and ask me why you're not 100% in stocks. That's not fair to me. But yes, I think as a professional investor, bonds having increased in value. So, the move this year is unbelievable. To go from a 2% 10-year treasury to a 0.5% 10-year treasury in a 2-month period, it's mind-boggling. That is the financial maybe overreaction that Andy and Drew and Lenny are talking about from the clinical standpoint. We're sort of seeing the financial side of so the coronavirus is not just a health event, it's now a financial event as well. But yes, we can talk about it, and yes, we should consider it, at least consider it. Or we don't have to get rid of all the bonds, but we may go all short-term bonds, and increase stock holdings a little bit. There's lots of things we can do. It's not all or nothing. All right, ready for the next question?
Okay. The next question is, why look at valuations if you are buying stocks individually?
Well, I'm not generally buying stocks individually. So I don't know who, if whoever's asking is buying stocks individually, well, that doesn't mean you don't want to look at valuations. You still want to look at valuations for sure. Valuations are always important to look at, whether it's an individual stock or a collection of stocks. The need to value doesn't go out the window when valuing an individual stock. You're just not going to get diversification from a To buy the single stock, you are taking management risk with that company and industry risk and who knows what other risk, right? And I can assure you that, Disney shareholders a few days ago or 2 months ago, maybe 3 months ago, were like, this company's impregnable. Right? Just like Citigroup shareholders right before 2008. I'm a shareholder in Citigroup. Nothing can happen to this company. So that's why we diversify. Who knows when the next thing is coming, financial crisis or virus or whatever. So that's why I try to diversify you. But the need to value doesn't go out the window if you're buying a single stock, not at all. Okay, next question.
I think that is it.
All right, everybody, thank you, and I'll look forward to being with you and talking with you in the days ahead.